Stay curious. JustProfessor here. Give someone insurance and they'll take bigger risks. Give someone a safety net and they'll make riskier choices. Protect people from consequences and they'll behave more irresponsibly. This isn't just theory. It's happening everywhere around you, and it's called moral hazard. Protection is creating the exact behavior it was meant to prevent. Imagine you lend your expensive car to a friend. They'll probably drive carefully because if something happens, they're responsible. Now imagine they have full insurance that covers any damage with no cost to them. Suddenly, they might drive less carefully, speeding a bit, parking in tight spots, not worrying as much. The insurance removed the consequences which changed their behavior. This is moral hazard, when protection from consequences makes people take more risks or act less responsibly. And it's affecting way more than just car insurance. It's shaping behavior in finance, healthcare, relationships, and almost every area of life. Moral hazard happens when someone is protected from the negative consequences of their actions, which makes them more likely to take risks or act irresponsibly because they won't face the full cost of their choices. The protection, whether it's insurance, a bailout, someone else taking responsibility, or any safety net, changes incentives. People act differently when they're shielded from consequences than when they bear the full risk themselves. This happens because humans respond to incentives. When you face the full consequences of your actions, you're careful and responsible. When consequences are removed or reduced, you can take bigger risks because you're not the one who'll pay if things go wrong. This isn't necessarily conscious or malicious. It's a natural response to changed incentives. Protection shifts the cost-benefit calculation and makes riskier behavior more appealing. The problem is, moral hazard creates a cycle where protection leads to risky behavior, which leads to problems, which leads to more need for protection. Insurance is meant to protect against bad outcomes, but it can encourage the behaviors that create those outcomes. Safety nets are meant to help people, but they can reduce people's motivation to avoid needing help. The very thing that's supposed to reduce risk can actually increase it by changing behavior. Let me show you where moral hazard plays out. Financial systems demonstrate this clearly. Banks that are too big to fail know the government will bail them out if they collapse. This creates moral hazard. They can take bigger risks than they would if failure meant actual failure. They get the profits when risky bets pay off, but taxpayers absorb the losses when those bets fail. The protection from consequences encourages the risky behavior that creates problems. The 2008 financial crisis was partly caused by moral hazard. Banks made risky loans knowing they could sell them off to others. Borrowers took loans they couldn't afford because they weren't thinking about long-term consequences. Rating agencies gave good ratings to bad investments. Everyone in the chain felt protected from the full consequences of their choices, so they took risks they wouldn't have taken if they bore full responsibility. Health insurance creates moral hazard in healthcare. When people don't pay directly for medical care, they use more of it. They might go to the doctor for minor issues they'd handle themselves if they paid out of pocket. They might be less motivated to maintain healthy lifestyles because medical care is covered. This is not people being greedy. It's a natural response to incentives where healthcare costs are separated from healthcare use. Car insurance shows moral hazard in action. People with comprehensive coverage might park less carefully, drive slightly more aggressively, or worry less about minor damage because insurance will cover it. They're not trying to commit fraud. They're just less motivated to avoid small incidents when the financial consequences are removed. This is why insurance companies charge higher premiums for comprehensive coverage. They know it changes behavior. Parental bailouts create moral hazard with young adults. If parents always rescue their kids from financial trouble, those kids learn they don't have to face consequences of poor money management. They might take more financial risks, save less, or make worse decisions knowing mom and dad will bail them out. The protection prevents them from learning responsibility through experiencing consequences. Employment protection creates moral hazard with workers. If someone has a job they know they can't be fired from, they might work less hard than if their job security depended on performance. Strong job protections can reduce motivation to excel because the consequences of poor performance are minimized. This doesn't mean all protected workers slack off, but the incentives shift. Welfare systems face moral hazard challenges. When benefits phase out rapidly as people earn income, it can create incentives to stay unemployed or work less because working more means losing benefits. The protection meant to help people can sometimes trap them because the system punishes the very behavior it's trying to encourage. This doesn't mean welfare is bad, but moral hazard must be considered in design. Relationships involve moral hazard too. If one person always forgives and never enforces boundaries, their partner might act less considerately because there are no consequences for bad behavior. The forgiveness and patience that should strengthen the relationship can actually enable worse behavior through moral hazard if there's never any real cost to treating the forgiving partner poorly. Credit cards create moral hazard by separating spending from immediate payment. You spend money you don't currently have, and the pain of payment is delayed. This makes people spend more than they would with cash because the immediate consequences are removed. The credit protection creates spending behavior that leads to debt problems. So, how do you design protections that don't create moral hazard? How do you help people without encouraging irresponsibility? First, keep some skin in the game. Protections work better when people still face partial consequences of their choices. Insurance with deductibles, for example, means you still pay something if you make a claim, which reduces moral hazard compared to full coverage with no cost. Making people bear some portion of risk keeps incentives better aligned. Second, make consequences clear and immediate. Moral hazard is worse when consequences are distant or uncertain. If risky behavior leads to quick, clear costs even with protection, people are more careful. Delayed or hidden consequences let moral hazard grow because people don't see the connection between actions and outcomes. Third, monitor and limit protected behavior. Insurance companies do this by investigating claims, setting coverage limits, and tracking patterns. This reduces moral hazard by making it harder to take advantage of protection. Some consequences remain even with protection, which maintains better incentives. Fourth, educate about long-term costs. Just because someone is protected from immediate consequences doesn't mean there are no long-term costs. Higher premiums, reduced opportunities, damaged relationships, these delayed consequences still matter. Helping people see beyond immediate protection to longer-term impacts reduces moral hazard. Fifth, create positive incentives alongside protection. Instead of just removing consequences, reward responsible behavior. Safe driver discounts, healthy lifestyle benefits, performance bonuses. These maintain motivation to act responsibly even when protection exists. Positive incentives can counteract moral hazard from removed negative consequences. Sixth, recognize moral hazard in yourself. When you're protected from consequences, check whether it's changing your behavior. Are you being less careful because someone else will pay if things go wrong? Are you taking advantage of protection in ways that hurt others or your future self? Self-awareness about moral hazard helps you act responsibly even when you're protected. Moral hazard is everywhere. Protection from consequences changes behavior, often encouraging the very risks the protection was meant to guard against. Insurance, bailouts, safety nets, forgiveness, credit. All these forms of protection can reduce people's motivation to act carefully because they won't fully bear the costs of their choices. This doesn't mean protection is bad. Insurance is valuable. Safety nets help people. Forgiveness strengthens relationships. Credit enables important purchases. But protection must be designed carefully to minimize moral hazard, keeping enough consequences in place to maintain good incentives while still providing genuine help. Understanding moral hazard helps you see why people sometimes act irresponsibly when protected. It's not necessarily that they're bad people. They're responding to changed incentives. It also helps you design better protections that help without enabling, and recognize when you might be experiencing moral hazard yourself. The next time you have protection from consequences, insurance, someone covering for you, a safety net catching you, check how it's affecting your behavior. Are you being more careful because you're grateful for the protection? Or are you taking bigger risks because you know you're covered? That awareness is key to avoiding moral hazard in your own life while still benefiting from legitimate protection. Subscribe to learn more about moral psychology and how incentives shape behavior in unexpected ways.